Welcome to the Intelligent Investing Podcast, where modern portfolio theory can suck it. A student of the School of Graham and Doddsville and a clergy member of the Church of Warren Buffett. Here's your host, Eric Schleien.
Hi, this is Eric Schleien. You're listening to the Intelligent Investing Podcast. Today we have back on Geoff Gannon, and he is the co-host of the Focus Compounding Podcast. Geoff, welcome back to the show.
Thanks for having me back.
Yeah, absolutely. So tell us a little bit about what you want to talk about today.
Yeah, so I wanted to talk about NACCO. So the ticker on that one is NC. It trades on the New York Stock Exchange.
All right. I think we talked about it briefly. It was probably about a year ago now that you were on the show.
That's probably true, yeah. So because that would have been after it had spun off Hamilton Beach Brands. So
right.
Definitely, yeah. So I've talked about it probably I've known about it for at least 2 years or something more than that, yeah.
Cool. So tell us a little bit about it.
So NACCO stands for North American Coal Company, and it is a company that operates mines on behalf of coal power plants, basically. So it operates lignite, which is brown coal, mines for power plant customers. And they're customers that are right there at the mine mouth so that they aren't transporting things, by rail and stuff like that.
Okay. And go ahead.
Well, and so the thing that's changed since the last time I talked to you is that the company has a lot of mineral rights that it's owned for a very long time because it used to do underground coal mining starting probably about 100 years ago. And it never sold those mines, never sold that land back east. And, the Utica Shale in Ohio has become a big place for taking out a lot of natural gas out of the ground, and this company has gotten a lot of royalties from that, and so that's changed sort of the earnings profile of the company.
Okay, so how has that changed exactly since last year?
So this first quarter, the company probably made about as much from royalties in one quarter as it did in all of any past entire year, probably. So I think that last year it earned about $5 total, of which maybe $1.50 or so was probably from royalties. And this year, it's it doesn't give explicit guidance, but you can figure out from what they said, if you think about what the next 3 quarters will be and what they've already reported, that they should earn somewhere more than $6 a share, but less than $9. And that increase is all from royalties.
Interesting. And then is that expected to continue, or what's behind that exactly?
Well, that's a very good question. We don't know because the company gives very little information about it. This is the first quarter ever that they broke out their business segments. So they had never broken the company down into segments. They just reported it all together. And now they've chosen to break it down. So they now have a minerals management segment. They probably sort of had to do that for SEC reasons. They would have gotten comments eventually from the SEC that you can't have this much earnings coming from something that you don't talk about at all. But for instance, they don't disclose, how many acres they have, but what the royalties are like, who exactly they're leasing them to, and things like that. You can kind of figure out some of that stuff, I would say. But they don't give information on that. And they do have an earnings call.
Geoff, why do you think that is?
Yeah.
That they're so private with this?
That's a very good question. I don't know. For one thing, I don't think that until recently they had a sort of a dedicated group in the business doing that. I think they hired one person, is my guess from that, and in terms of actually someone who's has engineering knowledge of petroleum sort of stuff. So I don't think they had anyone that was knowledgeable and dealing specifically with how to do their royalties. I think that they just they have coal mines in different parts of the country, and they've always gotten some royalties from them. They've gotten royalties. In some cases, they get royalties because people take coal out of places they took coal. In some cases, it was oil. Mm-hmm. And, I would say Utica is where so Utica Shale is where all this comes from. And probably 5 years ago, my guess is that no natural gas was coming from Utica, basically. So this is Ohio, particularly I think southeast Ohio is where they probably are. And that's just based on where their mines are and a couple things management has said.
Yep.
And I don't think there was any distribution capabilities there, like pipelines and things like that, to take stuff out of the state of Ohio until very recently.
So Jeff, I just want to take a step back for a second. So for those who don't know you, I assume it's the same as a year ago, but you have a relatively concentrated portfolio, right?
Absolutely, yes.
Right. So, this company deals with commodities. People might be wondering, well, if they knew you were a concentrated investor, why such a large allocation to a commodity business?
Okay, well, the reason for that is so with the coal contracts, those don't have any exposure to coal prices.
Okay.
There is risk in them, which is that the coal power plants can shut down. But to give you an idea, if you look at all the customers that they have, the customers would be obligated under contract to them in all but one case, as they have to be the sole supplier. So their sole source of coal for the next 12 to 27 years. That's what's left on the contracts. There are some contracts where NACCO has the option of not renewing them, but there are none where the customer can't renew them within 12 years. So 12 to 27 years of sort of guaranteed cash flows that way is an attractive business. And without any of these royalties, the stock was trading at maybe 8 times that free cash flow. It also has some net cash and things like that. So, when you have a 12% or so free cash flow yield, that's real. The contracts inflate basically with the cost inflation. That's very attractive to have that. It's sort of like having a 12% bond. But there is that risk that they could completely shut down the plants. If they don't shut down the plants, then they have to keep taking the coal.
Okay. And do you foresee that you would probably make about 12% a year on this investment, or do you think it's higher than that?
Well, I would think higher because of the natural gas. However, there's definitely risk in terms of coal power plants shutting down. I mean, they, just in the last 5 years or so, you've seen a lot of coal power plants shut down, and the expectation over a long period of time is for more and more plants to shut down. So that's definitely a big risk. Now, I should say, because, the company doesn't like that, it's always just talked about like, all this is shutting down without recognizing that at least until this year, we'll see. This year, it sounds like they might have a very, very small decrease in volume for the coal part of the business. But actually, as far as I'm going back, say, 5 or 6 years, every single year they've actually sold a bit more coal. So this company actually has not seen any declines in their volumes. But there's no doubt that nationwide less electricity is being produced from coal.
So why is that? How are they avoiding that decline?
Well, they opened new mines in some cases. They took over a mine from someone else. Because utilities usually don't want to operate the mine themselves, basically. Right. But they like to have a guaranteed cost. So the attractive thing from the utilities perspective is like I don't have the exact price, but based on sort of what I can calculate, I would say that they're basically providing them lignite coal at somewhere between $18 and $22 a ton with their management fee included. And so that's a guaranteed price basically that the utility is getting. And you don't have a guaranteed price usually when you use some other kind of fuel. If you're buying natural gas or if you're buying coal shipped in by rail or something, then that's fluctuating. Your demand for electricity and your pricing on electricity is pretty stable, especially if you're a regulated utility. But that's not the case with your input. And here you have basically, you can sign a contract that for decades gives you, in real terms at least, pretty much a exactly fixed cost. So that's the attractive thing for the utilities in the past. It's just the problem now is it's coal and, environmental issues and some other issues too about why you would switch to using other things.
Okay. I mean, do you think that's a pretty big risk though? Let's say this all plays out and their royalties severely decline over time. Does it then not become a good investment, or is it hard? Do you see it hard to lose money on this?
I think it's a risk. So an example is their biggest mines are in North Dakota, and North Dakota has the biggest lignite deposit probably in the world, I think. And it would just spread over from the U.S. a bit into Canada. And so in North Dakota, you wouldn't for instance, burn natural gas to use for electricity. Now, down in Texas, they have some mines down there, in Mississippi, places like that. Yeah, you would. But you wouldn't in North Dakota, which is their biggest part. But what you would do in North Dakota is wind. And so the issue here is basically if you were starting today, needing to start a utility up in North Dakota, for instance, you would build all wind. You wouldn't build any coal power plants, and you wouldn't dig any coal mines. However, the calculation's a little different because the power plants already exist and the mines already exist. So that's sort of the trade-off. But you have to understand that you wouldn't create these things today versus wind. And the longer that you have like cheap access to capital and things like that, the more it would make sense to build wind, because once you have the wind going, that works well. Now, I don't know, that you could ever, well, I don't think you can ever get 100% of your power supply from wind, just realistically for utility that's not a good base. But you could get a lot. Like I know that a customer of theirs said in a plan that they had a long-term plan going to 2030, they said they expect to keep their coal, their electricity from coal would be the same for the next 13 years, it was 13 when they came out with the plan, but through 2030, but they expect to double their wind. So, that doesn't sound bad because it means there's going to be no drop off in coal there, but that's a long-term plan and they change them all the time. You can see lots of projections in energy stuff that starts out by saying, oh, coal will be flat or something, and then later they, change it quite a bit. So, 5 years ago, no one thought that natural gas would be coming from Ohio.
So, if you had to give me the basic rundown, why do you feel with these risks that a company like this would deserve such a large allocation in a portfolio?
Well, it doesn't face any competition for the coal. So there's no competition, and they're guaranteed contracts, and they're real contracts. So I would say there's definitely a risk, but I think maybe the way of putting it is not that this is so risk-free, but I think that normally people underestimate the risks in their stocks from competition. And I'm not saying that in the long run you won't see declines here because it is coal, but I think that as compared to if you had a retailer trading at 8 times PE or something like that, well, they have a big competition risk. Here you have guaranteed real contracts as a sole supplier to these power plants for a very long time. Yeah, and for the most part, the volumes don't change much either because the plants generally produce almost the exact same electricity from year to year. Their populations don't vary that much.
Do you get killed, though, if interest rates go up a lot?
How so?
Well, if, let's say, interest rates go up and, now the risk-free rate's higher, does the stock go down? Do you think if interest rates go up? Not killed on the business, but just in terms of that there might be other better ideas out there if interest rates do go up.
Maybe it might be possible. Like I said, I think the yield as of last year was 12%.
It's just something I think about, right? We're in a low yield environment, right? And if interest rates do quote unquote normalize, whatever that means, right? That's debatable. But if they normalize back to say historical rates, then does it look so cheap anymore? That's just something I think about when I'm looking at investments where yield matters.
Right. It would matter a lot to the natural gas part because I would expect the price of things like natural gas to be affected a lot by that, and the idea to invest in the sort of projects that they need others to invest in. That's complicated because weirdly, on the one hand, their coal business is hurt by people investing in things like wind and natural gas and stuff like that. But of course, now they have this royalty from natural gas. Mm-hmm. So those kind of have opposite directions that way. Yeah, if there's not easy access to credit, I would expect way less production of natural gas long term from Ohio, especially because people don't want to build, the plants and things, chemical plants and other things that would be using natural gas, but also building the pipelines, building all sorts of things. You wouldn't do that unless you can borrow a lot of money, unless you think the price of petroleum products will be high.
Now, tell us a little bit. You said they have a natural gas business as well.
Well, I meant that they have royalties from it.
Got it. Okay.
Yeah.
Okay.
Yeah. It's very substantial now, though, because I guess they would have earned let's see, they would have earned, so it's, let's see, there's 7 million shares outstanding, and I guess their net royalties after whatever costs they have associated with royalties are probably around 12 million in the first quarter.
Okay.
So, so that's meaningful. The stock is a lot higher today than it started the year, though. It's at probably over 50 now, and it probably started the year in the low 30s.
Okay, wow.
And that's just because of the royalties. That happened almost all in one day.
Interesting. And you have no idea why it jumped that much?
Oh, no, I have a pretty good idea why the royalties jumped that much. So they had been – I knew that something like that was going to happen for a while because they used to always include language saying whenever royalties were high, they used to say, in their sort of guidance or whatever you want to call it, that they give a looking in the year ahead. They don't give numbers in it, but they talk about the year ahead.
Okay.
And they would say things like we expect royalties to decline or something. They always said that. Mm-hmm. And when asked about it, they said, well, we don't know, but whenever it's high, we just say we expect royalties to decline, And they stopped saying that. And then maybe 6 months or so ago, they said, we expect royalties to substantially increase. Yeah. Yeah, and the reason for that, looking at data, government data and things like that, is I would guess is because Ohio started having a very large number of wells for natural gas that were drilled but weren't completed. And while they don't say why that was, I think that means that there was nothing to take that supply out, and now they finished infrastructure that will let it come out of the state. So they would have obviously known that if people were drilling on their land but not yet taking out production, and all their royalties come from the actual production, that would be pretty easy to guess that production is going to spike.
Right. And what's the way that they return cash to shareholders? Do they buy back stock, issue a dividend? What does that look like? That's
a very, very good question, and that's a question that people are worrying about now. So this is a family-controlled company. And its roots go back about 100 years. And it bought other things over time. It diversified away from coal in a lot of different ways. So
was that the history of how they were connected with Hamilton Beach?
Yes.
Right,
so there's two public companies right now that are quite large compared to what remains of NACCO, that are also owned by, controlled by whatever this family, that they still have investments in it. Members wouldn't have to sell just because the spinoffs happened. So those two companies are Hyster-Yale, which is involved in forklifts and things like that. That's the easiest way to think about them. Okay. And Hamilton Beach Brands, which is microwaves and crock pots and those sorts of things. Yeah. And I believe from their history, the reason why they do that is I think it was McKinsey, maybe 30 or so years ago, maybe a little more than 30 years ago, to help them have ideas about what they should do. And they suggested diversifying into things that have nothing to do with coal. So that's what they diversified into. They have a lot of free cash flow for a long time from those sorts of things. But even that, they got into the steam coal business and the sort of contracts I'm talking about and stuff starting maybe in the 50s. Okay. And the reason for that is they already want to diversify away from commodity underground coal, higher grades of underground coal, which was their original business, because I think, I don't have data on it, but I think that they really got in bad shape during the Great Depression, like all the other coal miners. So from that time on, they tried to kind of look for other ways. I mean, it's almost like they've been diversifying away from the commodity of coal, like avoiding the commodity risk and stuff for, 80 years or something. I mean, as long as you can find stuff on the company, they've been trying to get out of that and into other things.
Yep.
So anyway, my point was buying back stock. Yes, they used to buy back stock, and they used to pay dividends. They do pay a dividend, but it's very low right now. And then they also spun off those companies. But they've been very clear about how conservative they want to be because of the industry that they're in. So they keep saying that they don't think that leverage is appropriate in this kind of industry. But at the moment, they have a significant amount of cash, I would say. So technically, they probably have like 80 million cash or something like that. I mean, as of the last balance sheet, but actually it would be a lot higher than that by now seasonally. Because of the way it works, you can tell that they're going to build up a lot of cash throughout the year. So this will become more and more of a problem throughout the year. The first quarter, they don't really build cash. So I would say, maybe they had 10 million, 15 million in debt and 80 million in cash. And like I said, there's only 7 million shares outstanding. So that's a meaningful amount of net cash. But they do have pension liabilities. They do have a cost to close one mine. In all other cases, the customer would have to pay them to close the mine, but there's one that they would have to close. And they have those old coal mines, which means they have to clean up water and some things like that too. So, those are things they're aware of. And I mean, even if you had to pay all those out of pocket right now, like fund them at 100%, they would still have a little net cash.
So what you were saying, there's a concern because they're a family business. Can you elaborate a little bit more on that?
Yeah, well, so I should say first of all, I actually like the management,
okay.
But other people may not feel that way because what has happened is since the spinoff, they have until last quarter they bought back no stock, and then they bought back some stock last quarter, and they don't pay much of a dividend, and so that would bother people. And the amount of the free cash flow build since they went to being just the coal business has been substantial. See, the coal business is really a free cash flow cow. And also, obviously, the royalties is just pure free cash flow.
Right.
But just the coal business alone, see, that was disguised because there are things that Heister, Yale, and Hamilton Beach can spend on. Hamilton Beach builds up a lot of inventory throughout the year and stuff. So it doesn't necessarily produce a lot of cash. But the coal business does. It's a service business, really. I mean, the way the accounting works, technically the way the accounting works is that the mines are all theirs. But in reality, that's not really how it works. How it works is they're basically getting like a management fee, and they talk about it sort of as they manage mines for others. That's the business they think they're in.
So what do you first see happening as the cash builds up over time?
I don't know. Anything is possible. So, a few things are not possible. I think there's no way the company sells out.
Would they make an acquisition?
Yes, it's possible they can make an acquisition, definitely.
And how's their history of capital allocation when it comes to acquiring?
It's okay. So they did a couple. They've said that they will not acquire a coal mine. They did acquire coal mines in the pretty recent past, and they didn't work out well. They ended up shutting down the mine. And they have one mine that they own that is a consolidated mine, meaning they provide the capital for it. In all other cases, the customer provides every penny of capital. So the customer provides all the money for them to the equipment and everything like that. And the actual business of a coal mine for a mine mouth operation is a low return. I would guess. My best guess is that they may earn maybe 6-7% on that one mine that they own. So they've said they would never do that again. They would never have another consolidated mine. And they did a purchase of a mine that they thought made sense before, and like an opportunistic kind of thing in terms of what prices were and stuff like that. And that was, it's closer to a decade ago now. And like I said, they said they're not going to buy anything like that. In every press release they put out, they include this language that that's not part of their strategy. An acquisition of an outright acquisition of a coal mine or something is not part of our strategy, that sort of thing. They've said they want to manage mines for others. They don't want to put any capital in. What I didn't mention is they have a third business segment, which is their lime rock business. And so that is where they're obviously trying to do, which is that mainly in Florida right now, they manage lime quarries for customers. And so it's exactly the same thing that you do at a coal mine, except it's lime.
So it's also a service business, basically.
Yeah. Now, the thing is, they do have enough money that if they want to ever buy outright a lime quarry or something, they have enough cash that you could do it. And I don't know if they would ever do that. I think they'd rather be a service business. I think that's the case. But
probably better for shareholders too.
Yeah, although there's in terms of the businesses that they're in, so they're going to spend $20 million on capex at one mine, which is the only mine they consolidate.
Why don't they just sell it?
They can't. They have a contract.
Ah, got it.
So that's, you have to remember that with all the mines that they have and all the power plants that the customers have, their contracts in place. So although they don't exactly say it this way, what is really happening is they have to put in the capex. They are saying that they have to put in the capex, but what they're not saying to shareholders really is we're earning these low returns because that's our deal with this customer. We have to do it to fulfill our obligation. The power plant needs more coal, so we have to buy more land, and we have to, these are surface mines, so they're huge, and a lot of the spending is literally buying more land around it and stuff like that. So there are years where they'll spend $20 million on that one mine.
Huh. But going back to what we were saying before, do you have any insight on how they would return capital over time?
Yeah, so I'm not sure that they would buy back stock regularly. The company said, in the last earnings call. So in the earnings calls, there's just one analyst on it. One time there was one private investor, but in all other cases, it's just this one analyst who asks the questions.
Okay.
And they said, some companies buy back stock regularly regardless of price. Maybe they want to, push up the price, or maybe they want to just find a way to use cash, but we don't do that. We only buy it when we think it's a good investment compared to other things and stuff like that. And so they hadn't bought back really any since the spinoff, and then last quarter they bought back some. It was a very small amount, though. But the thing is, in their history, they bought back a very large amount when they used to own the two other companies, Hyster-Yale and Hamilton Beach, 5 or 6 years ago or something now. So there was 1 or 2 years where they bought back, 5-10% of the stock all at once, and then they won't buy anything back for a while. They've always paid a pretty big dividend, but it's just never been a big payout ratio or anything. But yeah, they have a long history of paying a dividend. They still pay a dividend. It's not big, though. As a payout ratio, it's very low.
Right. Interesting. Anything else you think listeners should know about the company?
Yeah. So the thing is, it's hard to know how much the value is in the royalties. My guess, yeah, my guess would be that's a very, very big part of the value of the company now. And but you can't know that. So it's all fracking. So I mean, you can know in terms of. So if people don't know a lot about Utica Shale, the expectations would be that this is where we'll get most of our natural gas in the decades ahead. So 10, 20, 30 years out, most natural gas will come from the eastern part of the United States, not from places like where I am in Texas and stuff, which now produces a fair amount of natural gas. So the expectation would be it's all from there. In terms of geologically what's there, it's huge. And people have asked me, so how much does that mean that they have and everything? I don't think that's meaningful. Almost every year the reserves, the proved reserves, get increased for companies, there and for the state. But it's the economic issue of it, of what's economical to take out of the ground. That's what the limit will be on it. It won't be anything else. And then in terms of how long it lasts, that's the other question people ask. So how long is this royalties going to come in for? And it's hard to say because an individual well might last 18 months in terms of what most of its production is. But, there are some public companies or companies that at least release information to the public. There's one that releases information to the public about their reserves and things like that, who I think is leasing a fair amount of NACCO's properties. NACCO doesn't exactly say that, but they have shown pictures in their 10Ks in the annual reports and stuff, and if you look, the pictures are from that company, so you can tell that they're there, and we know that they lease most of the current production in that part of Ohio. So, okay. And that would be, I guess it's Ascent Resources. Its executive is formerly connected with the old, I guess, Chesapeake. So they're very aggressive in leasing things from there. And I know that they've leased things from other old coal companies other than NACCO. So they're probably leasing some of their land. So they put out things quarterly and stuff, so you can see what their production stuff is. If you match it up with NACCO, it tends to match pretty closely. I think in this quarter or whatever, if it was up 80 or 90% their production volumes, then NACCO's royalties were up 80 or 90%. So, it's probably a decent proxy for them. And I don't know, because even in their case, I think they're only producing a relatively. If you look at the land that's actually producing, the acres that are producing, might be less than half of their total acreage in terms of what their reserves would be. So they probably have half their reserves they're not actually producing anything on. So that's the same problem that you have with NACCO. We have no idea if 100% of NACCO's land has production on it, or if what we see now is only part of what it eventually would be. So obviously the reserves would last a lot longer if you are not currently taking natural gas out of all of the land that you have that has natural gas on it.
Interesting. Have you ever spoke to management of the company?
Nope, I've never spoken to management.
Okay.
Actually, interestingly, the coal business headquarters is right here in Plano. The corporate headquarters is in Cleveland. Yeah, but the main part of their actual operations are here in Plano, actually very, very close to where I live, because there's a lot of corporate headquarters there, and that is where they have a lot of their, business development stuff. And also the Lime Rock business does a lot of business development. So they spend a fair amount on that, trying to get new mines. There's some stuff in the proxy statements that you can see where they have kept certain goals private. And those goals all seem to be with getting a new contract in different things. So you can see that some of their executives have things tied to those contracts. And so those kind of headquarters of each of their business segments have it. Of course, there was no business segment breakdown at all for the natural gas royalties. But their corporate one is in Cleveland, but I don't think it's very big. It would have, it doesn't seem to be very big. Technically, from an accounting standpoint, North American Coal is not, I should say NACCO. So what you're buying is NACCO, and technically the debt and stuff that I'm talking about, the pension liabilities, all that stuff, that's actually not recourse to NACCO.
Okay.
Okay. I don't think that matters that much. I mean, maybe it makes it a little less likely your stock would go to zero or something. But I mean, all the cash flows and stuff are coming from that business segments that have those liabilities. So I really don't think it matters that much. But the company's been very careful. The family's been very careful to always do that sort of thing. So as you look at it, you realize more and more that at each level, they've a little bit more insulated. And that would have made more sense back when it was diversified that way, why you would have it sort of those compartments like that. Yeah, it's because you don't want Hamilton Beach to end up with the liability from the pension,
right.
Coal stuff.
Right. Huh, interesting.
Yeah.
Is there anything else? That's very interesting.
Yeah. My big warning about it is that the stock's up 50% in the last year, but the PE is not up. So in terms of like a forward PE or something, it would be the same as it had been before that increase.
And that was just basically because of the royalty increase.
Right. So it's from the royalties. And then the question is just like how much of those royalties are longer lasting and things like that.
Jeff, something I was thinking when you were talking before, the fact that the family does have a track record of, say, buying back large amounts of stock when they think things are cheap. Maybe they keep some of these things private because they don't want to, show their cards for maybe what they believe is to be a great business ahead, and they want to keep that as much under the radar as possible for as long as possible, so they can potentially buy back more stock if they can. Just something I was just thinking about.
Yeah, that is a possibility. I would say the biggest thing, which I didn't talk about with management, is as far as any management I know, maybe any management I've ever known for a public company, they're the most I don't even know if I want to say conservative, but they downplay everything a lot. They're the most so I would say that some reasons why you might not want to talk about what you own and stuff is it's just easy to make that very speculative. You don't want to say we own these many thousands of acres, and because like for instance, they closed down a mine in a completely different part of the country that does not have natural gas royalties on it. But we know in that case how many thousands of acres it was and stuff. If you include that in your 10K filings and talk about it and stuff, people start extrapolating these weird numbers from that. As if every piece of land that you has the same amount of mineral reserves and things in it. It's just very easy to get that.
Yep.
And I think that that's something that would definitely happen. That and just in general, like it is so much more low profile to have a company that you say we run coal mines than it is to say that we own a bunch of natural gas. That just attracts a different kind of shareholder.
Absolutely. Yeah. Well, I've noticed too with companies that are highly controlled by a family. I tend to find them more conservative, and they talk things down. They have no incentive to talk things up, really.
Yeah, and this company always uses the same exact language in everything it says, which is that that their board and other people like that have the interests of long-term taxable shareholders in mind, which is their code for family member, basically.
Yeah, no kidding.
Yeah, and so they're not going to sell the company or something like that, but that's the what they're looking for. I should say the company itself has performed well if you go back many decades, like the stock. So especially if you count the spin-offs and stuff. But this is not a stock that over the last 40 years has underperformed the S&P or something. So like in terms of the family keeping shares of it, and I keep saying the family, it's actually quite a spread out family now because they're all descendants of people who founded it 100 years ago. So there's multiple sides of the family and stuff. But it's just it hasn't underperformed or something. So they would have a substantial amount of their wealth in it because of that. Although they could have it also in the two spinoffs because you could just keep those spinoffs. You just never sell them. So in a way, you created a without paying a tax. You managed to diversify your portfolio into three different things. You know, you could never you didn't sell to trigger a tax because the spinoffs, if you do them right by buying and then keeping the business for 20 or 30 years and then spinning it off, you haven't paid it a tax on that.
Yeah, that makes sense. Interesting. Anything else, Jeff?
No, that's it.
Yeah, it's a very interesting situation. Well, Jeff, I appreciate you coming on. And
okay, thanks.
and you're always welcome on again if you want to talk about any other interesting businesses.
Okay, great. I should mention one thing, which is that mostly I focus on overlooked stocks, and the one warning I would put on this one is this is the least overlooked stock that I own. It is on the New York Stock Exchange. I think most people who know about it just know it has something to do with coal and don't really know what it does or anything. But it is its market cap is not really a micro cap quite anymore. It is on the New York Stock Exchange. It does pay a dividend. It's been around for a very long time, so it does have an earnings call, even though there's only one person on it. It's not completely undiscovered or something. So, it did go up 50%. So be a little cautious about, those sorts of things. I don't want to make it sound like this is something that no one's heard of or something.
Yeah, what is interesting, though, is if you just were to be scanning through a list of businesses and you happen to come across it, there's a very good chance you would never discover what we just talked about if you were looking at it, for a minute and really, it's a coal company. Oh, okay, interesting.
Yeah, absolutely. Right. I mean, my partner Andrew has talked to people about it. And in some cases they just said coal. No, I'm not doing it. No, don't suggest this. I do with coal. So yeah, but there's the risk from coal. So I mean, it is absolutely a coal company. It's just not exposed to coal as a commodity price. It doesn't have any commodity price risk.
Well, I've seen very few investments where it was a good investment with zero risk. So. If you want that, you can go buy a 10-year treasury and call it a day. And you're not going to do so well.
Yeah.
All right. Hey, Jeff, thanks a lot for your time, and I'll talk to you later. Have a good rest of your day.
All right, great. Thanks. You too.
All right. Take care.
Thank you for listening to the Intelligent Investing Podcast with Eric Schleien. If you'd like to connect with Eric for questions, comments, feedback, ideas, or to inquire about being on the show, please contact Eric at intelligentinvesting@gmail.com. So, in the words of Charlie Munger, I have nothing to add.